All right, everyone, let's talk about what's happening in the silver market, because things are getting intense. A document has just surfaced, and it's sending shockwaves through the commodities world. This isn't just another market fluctuation. This is a potential game changer, and it points to a massive leverage trap that could have huge implications, especially for precious metals. So, what's the story? This leaked document, which has been verified by several independent sources, exposes the inner workings of how some of the biggest players have been operating. It details a complex web of derivatives and leveraged positions, all built on a mountain of debt. Essentially, they've created a system where they can control vast amounts of commodities, like silver, using a relatively small amount of actual capital. Think of it like buying a mansion with a tiny down payment. It works as long as prices go your way, but if they don't, the whole thing can come crashing down. This is what we call a leverage trap. For months, maybe even years, these institutions have been suppressing the price of silver. They do this by creating paper silver, futures contracts, and other derivatives that far outnumber the actual physical silver available. This creates an artificial supply, keeping a lid on the price. But here's the catch. This game can only go on for so long. The document reveals that these positions are now so over-leveraged that even a small sustained move up in the price of silver could trigger a cascade of margin calls. A margin call is when a broker demands that an investor deposit additional money or securities into their account to bring it up to the minimum maintenance margin. If they can't meet the call, their positions are liquidated, often at a massive loss. Now imagine this happening on an institutional scale. If the price of silver starts to climb and holds its ground, these big players will be forced to either come up with billions of dollars they might not have, or they'll have to buy back their short positions in the open market. This buying frenzy is what's known as a short squeeze. When a large number of short sellers are forced to buy, it creates massive upward pressure on the price. We saw a glimpse of this with GameStop, but in the commodities market, the scale is exponentially larger. The document suggests that the leverage is so extreme that the ensuing short squeeze could be historic. We're talking about a potential repricing of silver that could happen very, very quickly. So what does this mean for you, the individual investor or someone just watching the markets? It means that the fundamental dynamic of the silver market could be on the verge of a major shift. The disconnect between the paper price and the value of physical silver has never been wider. While the paper market is caught in this leverage trap, demand for physical silver, coins, bars, and industrial use continues to surge globally. Mints are reporting shortages, and premiums on physical products are high. This tells you the real story. The physical market is screaming that silver is undervalued. This leaked document is the smoking gun. It validates what many of us in the precious metals community have been saying for years. The price has been artificially suppressed. Now the trap they set for others might be about to spring on them. We are at a critical juncture. The pressure is building and it feels like something has to give. Keep a close eye on the silver price, but more importantly, understand the story behind the numbers. This isn't just random market noise. It's a battle between paper manipulation and physical reality. The exposure of this leverage trap could be the catalyst that finally allows silver to break free and find its true market value. The coming weeks and months are going to be absolutely crucial. This is a story you definitely want to follow. Thanks for watching, stay informed, and I'll see you in the next update. Here's the key. A leverage ratio isn't just a number. It's a fragility indicator. At 4,000.1, one thing matters more than anything else: behavior change. Because paper systems don't break when they're over-leveraged. They break when people notice they're over-leveraged. That's why leaks matter. A spreadsheet, if believed, becomes a coordination device. It tells every holder of paper silver the same message at the same moment. You are not early, you're not crazy, you're not alone. And when enough people receive that message, the paper exits become synchronized. The transcript you provided frames it as the end of estimates and the start of internal bank data. Whether it's ultimately verified or not, the danger is that markets trade perception first. If investors believe that allocated is scarce, they try to convert unallocated to allocated. If they can't convert, they try to withdraw. If they can't withdraw, they try to sell paper and buy physical. And if physical is unavailable, the premium splits from spot and creates two prices: paper silver and real silver. That's the reset dynamic. It is not a magic revaluation decree. It has a market split that eventually forces a repricing of the reference price itself. Now add the industrial side. In your transcript, it claims large manufacturers began demanding delivery in late 2025. Whether the company names are literal or illustrative, the underlying point is real. Industrial demand can be inelastic. Solar, electronics, medical applications. Some processes don't swap out silver easily, not quickly. So if even a small share of buyers becomes must have metal, and the investment side becomes must get out of paper, the same ounce gets chased by both sides simultaneously. That's when exchanges raise margins, position limits tighten, and cash settlement becomes the pressure valve. But the pressure doesn't disappear. It just moves into physical markets. Shanghai, Dubai, private vault networks. Anywhere an actual bar can change hands. And that's why a 4000.1 claim structure can't be managed. It can only be reduced. And reduction happens in only 3 ways. Defaults are cash settlement forfeiture, moratorium forced liquidation, repricing high enough to destroy demand and pull supply out of hiding. That's the reset. Let's talk about the most viral part of your title, mathematical certainty. Strictly speaking, no market price is guaranteed, but structural constraints can force the range where equilibrium must occur. Your transcript proposes a clearing logic like this. When delivery demand rises above the fraction of metal available, the price must rise until enough claimants choose cash instead of metal, because the metal simply doesn't exist in deliverable form. It also proposes that panic will cause many paper holders to dump exposure at any price, reducing the number of claims actually demanding delivery. That produces a clearing price, the zone where the remaining true delivery demand can be met. Enough holders of physical are willing to sell. Industrial users still function, or redesign for thrift. Paper claims shrink via settlement, talks forfeit. In the transcript, the suggested clearing region eventually stabilizes around 485 Oz after extreme volatility. Do I want you treating 485 as a promise? No. But I do want you understanding the mechanism. The more leverage and rehypothecation, the more the system depends on confidence and low delivery rates. When confidence breaks, price becomes the only tool left that can ration the remaining physical supply. And rationing isn't gentle. It's not a rally. It's a forced repricing event. This is the same logic behind historical commodity squeezes. The market finds out what the real supply is only when someone demands delivery and the warehouse says, we can offer cash. At that point, the price is no longer discovery. It's triage. And in silver, the emotional fuel is even stronger because silver is both an industrial input, a monetary metal with deep distrust narratives around paper claims. That combination is why silver squeezes tend to be chaotic. If this death bag leak gains mainstream traction, the next phase is simple. People stop debating ratios and start demanding bars. Now, let's map the next steps in a realistic news-based sequence without pretending we can predict exact days. First, verification warfare begins. Banks deny. Analysts argue. Screenshots circulate. The public asks, is this real? Second, paper-to-physical migration accelerates. The moment even a small percent tries to convert unallocated to allocated, bottlenecks appear, because allocated metal requires specific bars and legal segregation. Third, premium blowouts intensify. Dealers widen spreads, inventory disappears, delivery times extend. The spot price may rise, but physical premiums often rise faster, creating that two-price market. Fourth, ETF stress narratives grow. Whether it's an SLV or any other vehicle, the key issue is not the ETF is a fraud. It's this. ETFs are not designed to satisfy mass retail redemption for bars. Their mechanisms work through authorized participants, baskets, and logistics. Fine in normal times, fragile in panic optics. Fifth, exchange interventions, margin hikes, limits, rule changes, emergency settlement clauses. These are designed to reduce disorder, but they often signal stress. Traders read them as confirmation. Sixth, industrial contracting shifts. If manufacturers fear supply disruptions, they lock in long-term contracts directly with miners and refiners. That diverts supply away from the open market and tightens spot even more. So the contagion chain is leak, belief, conversion demand, bottlenecks, premium blowouts, interventions, physical repricing. Notice what S missing. A central authority announcing a reset. Resets happen because the system can't clear at the old price. And once clearing fails, the market must discover the price where physical actually changes hands in size. That's the real benchmark, not the quote on the screen. Let's finish with what this means for regular people watching this. 1, if you hold paper exposure, understand what you own. Is it allocated, unallocated, a fund share, a derivative, a futures contract? Each behaves differently in a stress event. The crisis, if it comes, is not silver goes up. Its delivery becomes the product. 2, if you hold physical, remember, volatility is part of the deal. In a reset scenario, price won't move like a stock. It gaps, spikes, retraces, and premiums behave differently than spot. 3, don't let viral claims replace verification. The transcript you provided is extremely specific. Numbers, times, mechanisms. That specificity creates authority, but it still needs confirmation. Until confirmed, treat it as developing information, not gospel. 4, if this leak narrative spreads, the biggest near-term driver may be psychology, not mining supply. When trust breaks, the market shifts regimes, paper confidence to physical preference. And that's why the phrase 4001 matters. Even if the true number is lower, once the public believes it's anywhere